It's great to have you both here. And Vahan, kick things off for us. Why are you, after the conversation we were just having, I'm feeling ebullient, I guess, about the labor market and economy. What am I missing, and why do you feel a little bit more cautious?
Well, I'm a little cautious for a number of reasons. I actually expect longer-term interest rates to go up, even though the Fed is reducing the Fed funds rate, because we're going to eventually get a more normalized yield curve. I think that's a good thing, and I believe that that's the kind of yield curve that would favor more of what I would call the safe stocks or the value stocks, the dividend-paying stocks, and we could perhaps see a bit of a sell-off in the sectors of the market that have benefited the most recently. And that keep in mind, of course, lower interest rates are good for all kinds of stocks, including growth stocks and value stocks. But I think an upward sloping yield curve would favor the value stocks over the growth stocks.
And I so want to dig into the wonkiness of this, but I want to make sure in doing so that we talk about the stocks that you think are going to do well here. Just to rattle off a few examples: IBM, Verizon, Pfizer. You like the small caps. You've got the small caps and the triple Qs. You've got the semis. Just talk me through this.
Okay, so over long periods of time, we've known that in the U.S. stock market, value stocks have outperformed growth stocks, and small cap stocks have outperformed large cap stocks. Now, this has not been true in the last 10 to 15 years, and I think the reason is because the Fed has been dealing with all kinds of crises, and they've done things that we've never seen before, basically bringing interest rates down to 0%. Now we're in a more normalized environment. The yield curve is uninverting, and I think it'll continue to uninvert till it becomes, more normalized. And I think that brings us back to what I would consider normal, and it brings us to an environment where we could once again see value outperforming growth and small outperforming large.
Yeah, it's Margie's with the Allspring Fund, but this is like a hope springs eternal kind of stuff. But I don't want to be too cheeky because, you have a kind of barbell strategy where your bets are somewhat hedged. If the big caps keep outperforming, great. If the small caps, which have been outperforming the past 3 months, keep doing something, that's great as well. Margie, your thinking is also on kind of a more sluggish growth period. What is that, and what stocks do you want in that environment?
Well, I think realistically, we should expect slow growth, even though the Fed is cutting rates, long overdue on that part. And we see that as a sign from stress in labor that we've seen now for really since the end of 22. So we think slow growth is most likely for the next few quarters. And I would say what I'm looking at is not so much a macro sector, large, small growth value, something like that, but companies that have some sustainability to have an earnings growth rate much above even a low level of growth. So that's why we like things like Broadcom in the semi space, very diversified, involved in leading edge products, and has a very good track record of making acquisitions to add value. Something like Eaton, which is involved in increasing our grid capacity and improving the transmissibility in the electric utility industry, which we think is a big, many-year trend ahead of us. And we also like Vistra, which is an independent power company. We think that we can see there's a shortage of baseload power, and we think that Vistra is well positioned with their power to have high earnings for the next few years. So those are what we like, what the companies are going to do rather than a macro approach, large, small.